down 53% off its high, I think Netflix is one growth stock you might regret not buying on this dip. Now, I recently reviewed Netflix's latest earnings results and I've looked at its long term financial results. And given all this comprehensively reviewed information, I want to reiterate my recommendation for Netflix stock. And in this video, I want to share with you a few of the reasons why I'm bullish on Netflix stock. So let's begin. Starting with Netflix's revenue growth over the years. If we look back, let's go back longer. Let's go back over the last decade. Netflix has done an excellent job pioneering the streaming industry. It's reached the level where its quarterly revenue is at $8.162 billion, and that's huge because that's a scale at which Netflix can now incorporate a larger and larger content budget because now it's got more and more people that it's showing that content to. It's spreading that cost across a greater number of people, across a greater revenue base, which allows it to spend a lot of money on content and still remain profitable. Now, Netflix has over 200 million subscribers, but that's still, I believe, not where it could be in the long run. Now, the CFO a couple of years ago was talking about, you know, a reasonable expectation for Netflix, by 2030 is for it to have 500 million subscribers by 2030. Now, you might say, whoa, that's a long way from the 220 million it has right now. And I would say, you're right. Yeah, but if you think about the total addressable market for content viewership, it's much larger than 500 million, right? There are 1 billion broadband households in the world today. So there's 1 billion people that have a broadband internet connection that can access Netflix essentially. So there is, and saying 500 million would be half of that, just half of that market size. And if you consider that there are still millions of people that have a traditional cable or satellite subscription, and you think about all the benefits from streaming content over cable or satellite, you can start to see that Netflix still has a lot of room for growth here. It's still, it's only a decade into this, so it's got room for growth. The other thing I wanted to highlight is Netflix's operating profit margins. As I mentioned earlier, the company's done an excellent job boosting its profitability while boosting revenue. And look back over time, it's boosted its operating profit margin from less than 6% in 2014 all the way up to a high of over 20%. Of course, that was unsustainable during the times when we were all locked down at home. And now it's at 16.85%. I suspect this operating profit margin will flatline around 16 to 15% and then reverse back higher. A couple of things happened during the pandemic that first increased its profit margin and then brought it down. First, because we were spending more time at home, demand for Netflix soared, right? That's one. Second, it didn't have to spend any money on content. In fact, it couldn't, even if it wanted to, because production was prohibited by many governments because of lockdowns. They said, hey, you can't bring all these people together to make a movie or make TV shows when there is COVID-19 in circulation. No, 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 no. So, Netflix has this big surge in customers and then at the same time has a big drop in spending. So profit margins soared in response. Unsustainable, right? Okay. Another thing that happened is competitors saw this as an opportunity to say, hey, if we're ever going to launch a streaming service, now's got to be the time. So competition soared during 2020, 2021. Many streaming services entered, but not only entered, but entered at introductory prices, very low prices. If you remember, Disney Plus started at just $4.99 per month. Now it's up over $7.99 per month, so almost double the price. You had others that came in with introductory pricing and then have recently raised prices as well. People came in, like Disney came in and said, hey, we're going to spend $33 billion on content. Now they're saying we're going to spend $28 billion on content. So incrementally, competition is now decreasing. Streaming services are saying, hey, we're done with all of this investment in our streaming segments. We're now ready to start harvesting and generating profits from our investments in our streaming segments. So that's good news for Netflix, because increasing competition is bad news for investors. I've said this a lot when I talk about Uber and DoorDash. I've said this a lot when I talk about Tesla and all the EV companies with all the competition there and the price cuts. And I've said this with the streaming industry when they were going through it in 2020 and 2021. Now it's good news for investors that every few months you get another signal from a major streaming competitor saying we're either going to raise prices or we're going to cut spending. And either way, it's a move to decrease competition. That's good news for profit margins. And then you have cash flow from operations to sales over the trailing 12 months. And again, Netflix has done an excellent job. Of course, there was a boost here. Let me go back 10 years. There was that boost during 2020, unsustainable. But after that drop, it's reaccelerated again back to 10.29%. This is a more sustainable boost in cash flow from operations to sales because Netflix has reduced the content budget. They've increased prices. They've added advertising tier. They're cutting down on account sharing. So that's a way to drive incremental cash flows, all of which is helping to boost Netflix's cash flow from operations. And they've said from now on, we're going to be cash flow positive. So no more of these negative cash flow from operations days from Netflix. And again, it's another sign to the industry when they said that, hey, from now on, we're going to be cash flow positive. That's another way of telling the industry, like, hey, we're not going to go out of our way to spend so much money to attract customers. We're going to be making sure we're profitable. And that's another signal to the industry, which the industry could then respond to by saying, okay, Netflix, we see that you're reducing competitive pressure. We will follow you, and we will also reduce competitive pressure because that's good for all of us. That's good for all of us streaming companies. Might be bad news for customers, but that's okay, right? We're interested. We're Netflix. We're interested in making money. We're Disney Plus. We're interested in making money. It's okay if customers have to pay a little bit more, right? It's okay, right? That's, essentially the thought process between the industry saying, let's get less competitive against each other. Let's start to generate some profit margins because otherwise we'll all go out of business and the viewer will have nothing to watch if we go out of business. So it's in their interest too for the long run. And then finally, Netflix is not expensive at all. It's trading at a forward price to earnings ratio of 22.42. And given all of the factors I discussed in the video, I suspect that Netflix's earnings will face difficulty for another year, maybe year and a half, but will stabilize and grow for the longer term, for the rest of this decade, because of easing competitive pressure, rising economies in scale, and lower content budgets or overall, and the decrease in account sharing and all of the other reasons too. So a really good opportunity here. I think you might regret if you don't buy Netflix stock on this dip here. All right, thank you so much for watching. If you like this content, go ahead and subscribe. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.